Well, thanks. This is Mark Blood. Thank you, Lydia. Thank you, Dan, for having me come in and speak today. As I was walking onto campus today, I was thinking about planning my own succession. I don't know how many of you have recently been on campus at RIT, but this place is a lot cooler than where I went to college, and it might be nice to have a segue in my life where I go back to being a college student at this point in time. So
lifelong learning, Mark. That's what we're all about.
That's exactly right. So thank you again. I guess I'm honored to be here with Dan from the perspective of he has a lot more knowledge than I do and a lot more life experiences than I have. I'm not calling him older or anything.
I'm just going to say that just means I'm older, but I'll get into that shortly.
So today we're going to spend a little time talking about some of the things that we see in the succession planning world. And the very first slide that you see is it says, to what is succession planning principally responsive? And there's a big set of words underneath that that says business valuation. So literally this morning I had an interesting interaction with a client of mine. As many interactions with clients start, they start with a text message saying, hey, can you give me a call? I need to talk to you about something. I don't think anybody calls anybody cold anymore in this world. You get the prep text message. And so I called my client back, and he tells me a short story about the fact that he had taken his father to the doctor the other day, and after they got done with his doctor visit, his father sits down in the car and looks over at him and says, hey, you need $10 million to retire on nowadays. How you doing toward that? And it started it on the conversation. He's a guy who's in his late 40s. He has 2 kids who may, at some point in time, end up in the business, and asked the question about, how do I begin to plan for my retirement? And the first reaction that I gave to him is that, well, one of the things we principally need to figure out is how big the pile of money needs to be. And you could see he was kind of cross-eyed on the other end of the phone, even though you couldn't see him. Because what I was really asking him was for you to be able to lead a retirement the way you want to lead your retirement, how much money do you need to have at that point in time in order to be able to fund the cash that you need to live on? And he thought that was kind of an interesting way to go about it, because he always thought that retirement planning would be the other way around. You determined how much money you had, and then you thought about what your lifestyle was. But really what it's about is determining to a great degree what you want your lifestyle to look like in retirement, and then begin to back into what you would do from a succession planning perspective in order to be able to support that retirement. And with many people who own businesses that are trying to plan their succession, one of the biggest issues they have is business valuation. How do they promote succession in their business in order to be able to enhance the value of their business? So we're going to spend a fair amount of time today kind of talking about some of those issues. And you see in the next slide, basically, I asked the question, what promotes, preserves, and enhances business valuation? And to a great degree, we're going to talk about some of those things that kind of, I guess I would say, begin to speak to the question of how big the pile of money needs to be. It sounds like kind of a backwards way to go about it, but many of the topics that we're going to talk about are going to be topics that hopefully give people some insight into how they can enhance the value of their business, so that as they look through to their retirement and they look through to the succession of their business, they can develop some takeaways and some strategies to be able to pull off a successful transition. So in the slides, we're going to talk a little bit about management succession. We're going to talk about leadership or governance succession. We're going to talk a little bit about financial strategies, what you should be thinking about on your financial statements. We're going to talk a little bit about some family business concepts, and then in the end, we're going to talk about a few hard topics. And I think probably many of the hard topics Dan has seen in his days of board governance, where you might have fellow directors that are like, hey, that's a real hard question.
Yeah, absolutely, Mark. And good afternoon, everyone. Unless you're in a Western time zone, then good morning. Okay, so Mark is going about this in the context of what I would consider to be an organized transition or a plan for transition or succession. My experiences are, first of all, I had 3 CEOs died while they were in office. On one board, we fired one. That required succession, of course. And in other cases, it simply was a matter of selling the business and deciding, okay, who's going to succeed. But from my world, the first and foremost responsibility of a board member is to hire and compensate the CEO, which of course means if the CEO is gone, we're back at it. Hire and compensate the new CEO, figure out who it is that's most qualified to take over the reins. So there's sort of a lot of tentacles to the possibilities here regarding succession planning, but I think in Mark's world it really is about privately held companies and normal, if you will, if we can use that word, if there's such a thing, transition planning. Not a pleasant thing for many boards and businesses to talk about, actually.
And that's probably an interesting segue into the next slide that you see that talks a little bit about management succession. You know, one of the topics that Dan brought up is succession at the CEO level, and that succession comes in lots of different ways. It comes because you have a great CEO who someday says that they're going to retire, or you have the CEO that you walk in someday and say, you're going to retire today. And all of those things happen in a myriad of businesses, from a business that has $5 million a year in revenues to a business that has $500 million a year in revenues. But I think, Dan, it's fair to say that those CEOs that are the ones that are the great CEOs, those are the CEOs who lead rather than tell. And what I mean by that is they're the guys who are out in front of where the business strategy is. They're the guys that are showing people the way to promote value in the business rather than telling people what to do. And I think there's a difference in those CEOs.
I do too, Mark. I think the legacy of the successful CEO is that they delegated to very talented people the responsibility to run the day-to-day activities of the firm, and that they really oversee, like an umbrella, the whole environment, not in any dictatorial sense. It just doesn't work in today's world. So that's really what boards are thinking when they talk about, all right, if our CEO isn't with us, what do they leave us with, and how do we move on from there? So yeah, there's these leadership styles that are critical to the succession planning.
So I thought it was interesting, and really the next bullet here is about talent. So I mentioned, as we were chatting before we started on this, that I spend a little bit of time doing some podcasting, and I also listen to a lot of podcasts. And there was an interesting podcast that had an interview with Indra Nooyi, who was the outgoing CEO of PepsiCo. And she made an interesting comment and basically said, on the day that I became the CEO, I was working on replacing myself, and I was working on collecting the talent to be able to replace myself. And that really, to me, segues into the next two slides on who is next and who is not next. I think the interesting part about that, when you look at management succession, is oftentimes the CEO and the other people that are in the C-suite look at themselves as being who's next, rather than the collection of talent being who's next. And the great CEO and those great people that are in the C-suite are actually identifying the people that they've surrounded themselves with as being who is next. Because I think in reality, in most instances, the CEO that you just hired is not up next. And the reality, I think, that comes along with that is the ego part of what we put into the title of this presentation. And Dan, I'm sure you've seen some of those egos, and you've seen people manage through those egos.
Yes, and some of the worst stories that I recall are CEOs talking to the board, well, what are you going to do when I'm gone? This place is going to fall apart. And I'm like, you're a bad CEO. You should be seeing to it that when you're gone, the transition will be as seamless as it possibly can be. And so I'm very sensitive to that part of that slide regarding who's next and who is not next. And, you know, there are thousands, as we know, of privately held businesses that are right in Mark's sweet spot that don't really have boards, if you will. They might have advisors, but Mark becomes the advisor. Their accounting professionals become their advisor. But in my world, where the board is more formal, that who is next, that is an executive session issue that must be addressed, because as Mark said, a lot of people who might be in the room in a normal board meeting think they're all going to be next, and it just doesn't quite work like that.
Well, and one of the things that oftentimes comes when you're trying to identify who's next, especially when you talk about family business situations, is you oftentimes have a parent who's sitting and having a conversation with their son or their daughter, and the parent is oftentimes having a hard time trying to figure out whether their kid is really next. And I literally at times have conversations with my clients to say, you're looking at your child as them being the person that you changed their diapers 26 years ago. And the reality is you need to determine whether they're truly an adult and truly a professional who can be a part of who is next. And sometimes your children are not who's next.
Right.
And the person who has truly compartmentalized their ego and has compartmentalized how this plays into their business sometimes has to make hard decisions that their family member may not be who's next.
And Mark, it's a two-way street, isn't it? I've been in situations with privately held businesses where the parent or the founder has built a beautiful company, and the children have said point blank, I don't want anything to do with it. So we got to go down another path, and of course, here we go. How do we?
That's funny. Both of my kids said that.
Yeah,
you're crazy to be an accountant.
so it can happen both ways. In the meantime, it's going to happen. Is I think a big point of this a webinar. And if it's going to happen, how do we do it most effectively to protect the interests of all parties?
So we have a question coming in specific to privately held, family-owned companies. Is it possible that we should be talking about what's next rather than who's next, because the who always means a particular person?
I think it's actually kind of both of those mixed into the blender at the same time. I guess you could say there's analogies with that. You know, different horses for different courses. You have golfers who play better on one course versus another course. So have you thought about your business strategy and your business plan, and have you matched the right people up with it? I tend to be a person who believes that management team wins out over business strategy any day. And I guess another way to say that is, I think if you have an A management team, that they can take a B- business plan and turn it into a great business plan. Where if you have an A business plan and you have a B- management team, you're probably going to take an A business plan and turn it into maybe a C. So I don't know what your experience is, Dan, but I don't think it's a lot different than that, because I know some of the companies that you've been involved in, and they have great management teams that have built fantastic businesses.
Yeah, of course. I think, you know, it's really, in my mind, we look for the jockey more than the horse. So we want good leaders, and we believe they can bring marginal business plans to very successful conclusions. But in the context of, okay, we got a family business, we don't want to talk about only who, what about what. Well, in the scenario that I briefly described earlier, where the founder's children were not interested, the founder at that point put a board together and said, okay, advise me, because if my children aren't going to take this over, then I only see a sale, and I don't want anything to do with the sale. I want somebody else to lead the sale. I want a board to represent me. So you know, what's next is who, or do we even continue in this business? And those are pretty gut-wrenching board meetings, believe me, where there's a lot of emotion at play, and the board's trying to be in its fiduciary role, independent, if you will, but closely held businesses, there's a lot of emotion there. So from my perspective, it's what is next, who or what, whatever it is. So
I think it can be a unique combination of both of them.
Yeah.
The last couple of bullet points on this, or last, you know, the two kind of bullet points that look the same on this slide: experience in time and understanding the business, and experience and opportunity in decision making. You know, oftentimes as you look at management succession, the management succession comes out of the ranks of management that you've developed. So you have a CEO, but you might have an operations person who's coupled up with them, and you're looking at the operations person as being somebody who could succeed to the CEO role. And I think many businesses and many clients that I've seen struggle with the idea of how quickly and how soon do you begin to hand off decision-making capabilities to the people that are next, so to speak.
Yeah.
And, you know, the experience in time and understanding the business, oftentimes the founder of the business, the significant owner of the business, what they know about the business is almost a reflex. They have things that they think and they know about the business that are like so ingrained into their brain that they just react. And they think that other people that are around them get it the same way. And one of the things that we found in our business is that we're trying to take people that are in manager roles in our business and that are in senior manager roles in our business, and we're trying to expose them to the decision-making process so they have practice at making decisions.
Yeah.
They have practice at understanding the business, because I think our fallback position is, yeah, we know that. We understand how the business operates, and we think that permeates the organization, but it doesn't. And I'm sure, Dan, like in your case, you've seen those situations where you look at people that are in management roles and you go, how come you don't get that?
Yeah.
How come you don't understand that about it?
No, the square pegs into round holes, and I think there's a question up here that hits that nail right on the head. And so I think in modern compensation or equitable scenarios, empowering employees to make difficult decisions that are aligned with the interests of the owners would suggest that those employees have some ownership interest, that they start to think like owners and understand more clearly the impact of their decisions on the value of the company. Well, if you're a founder and you're 100% owner, this is like giving up your firstborn to some of them, that they're like, wait a minute, I want complete control here, and I think it's really incumbent upon advisors to say, you know what, you can have 100% ownership of something worth, let's say, $10 million, or 60% ownership of something worth $50 million, and then the thought starts to go to, okay, at some point I'm not going to be here. I'm hoping for a higher value.
But that speaks to business valuation.
Yeah, absolutely.
Because when you've thought about that, you've thought about it in the sense of what's really promoting value. And I think the fallback position that you were talking about is you have that founder who wants control. They want that ultimate control. And actually, in my experience, the more they want control, the less control they have.
Yeah.
And because you haven't surrounded yourself with that talent, that really puts you into a position to enhance the valuation of the business.
Jack of all trades in business just doesn't work. I mean, it can work, but it does, in fact, diminish value in almost every case.
So, Lydia, can I read the next question up here?
You absolutely can.
It says, I've heard that some small businesses transfer over from the original owners to employees as owners. How common and difficult is this process? I can answer that very quickly. We're going to touch on it a little bit later on as we talk about financing in transactions and so forth. How common is it? Very common. How difficult is it? Very difficult. And the reality is, if you look at succession in many small and medium-sized businesses right now, many of them follow this path, and we're going to talk about in a couple of the later slides. We're going to talk about a couple of the little I guess, characteristics of those transactions.
It's a great question, by the way, and one that's on the mind of, should be on the mind of all privately held businesses. In the publicly held arena, it's common. It's not that difficult. We generally do it with options or stock appreciation rights, something that's observable objectively. There's an outside market, but in the privately held business, but we still struggle with it even in publicly held. Who gets them? So in the context of this question, transfer from the original owners to the employees, what employees? All of them? That's a possibility. A select few? That's another possibility. And those are very difficult questions, because you don't want to please a few at the expense of the many, if you will, and you don't want to please all of them at the expense of the owner. So
it's kind of like, using a sports analogy, who gets to travel with the football team and who doesn't, and who doesn't suit up on the weekend.
Exactly.
So it's a very you'll see some interesting and hard issues when you talk about those closely held businesses.
Yeah, but in the single owner, the original owner, they control. So we're not going to do anything that they don't agree to.
Right. So we're going to segue a little bit to corporate governance and succession, and start kind of at the top of the hierarchy in formal boards. Dan has a lot of experience with formal boards. That area of governance, since the Enron world, and since a lot of Sarbanes-Oxley and so forth, has been a very changed world. Very. And the requirement for members of boards to treat it as truly a business enterprise. Being a board member is a business, and you need to function like a business person would function. It's not just show up, have lunch, and have a drink afterwards. No,
it's not even close to that, and I'm unfortunately not old enough to know those days. I imagine it was a pretty easy show, but today we are very, very aware of our responsibilities and our exposure. So, but why would you sit on a board becomes a legitimate question given that exposure, and you do it because you hopefully have a background, that you believe there's some prestige to it, and there's compensation. But all of those are trumped by what are we doing the right thing, and do we have the right people on the board to lean on to determine what the right thing is. So formal boards, and I put up there maybe publicly held boards, which are under heavy regulatory requirements, versus privately held boards, which are advisory boards more than controlling boards. So in the publicly held arena, we tell the company, the shareholders, here's your CEO. In the privately held arena, we might recommend, but the owner is still going to make the decision.
And the segue on that is that if you look at large organizations, you look at publicly traded organizations that really do have formal boards, you look at many small and medium-sized businesses, many of them have informal board structures. They have informal groups of advisors. I have clients of mine that are middle market companies that I actually sit on their board. It's a board that is not imposed on them by a corporate governance structure, but it's a board that they want to have. They want to have that input from a set of advisors that have some deep knowledge about their business and are willing to come to a meeting and tell them hard things.
Yeah, I think they're invaluable. It's you know, some owners are like, I'm not sure I want to share all this with others, but you have to convince them, look, this is a very effective way to access significant experience and skills without having to make, you know, a hiring commitment to them. This is becoming more and more acceptable, and I think it's a great direction for privately held businesses to go in.
And the segue on that is many informal boards. If companies don't have an informal board, oftentimes they have, you know, a key set of advisors. And one of the things that I always said over the course of my career was I wanted to be in a position, this is really dating myself, but I wanted to be in a position that when I looked at the speed dial list on my client's phone, that I was toward the top of the list. I really thought I was successful if I was number one, but I thought I had some level of success if I was on one of those buttons on their phone that they'd press to immediately be able to dial out to somebody. And in the world that we live in right now, if your key advisors, your accountant, your CPA, your attorney, your insurance guy, whoever else is influential on your business, if those aren't people that you freely pick up the phone and call, or I guess in today's world you text in advance of making a phone call to them, if those aren't people that you would feel free to call them up, have a beer with them, have a cup of coffee, you might have the wrong advisors. Mm-hmm. And I'm sure, like in your case, Dan, with many of the boards that you're on, there's board meetings, there's committee meetings, but I think much more probably what you did was an informal phone call where they were looking for your advice.
Yeah, absolutely. It happens more and more frequently. Formal board meetings, obviously, you don't schedule one every week, but issues come up every day. So I had a call this morning from the head of internal audit of a company I'm on the board of, asking some very specific questions about presentations that were going to come up at a board meeting that's scheduled a couple of weeks from now. And this is how I like to operate it, that there's no barrier, if you will. If you're going to be a board member, an informal board member, a key advisor, it suggests you're available.
Right, and what really sets you apart is you're in the position where you're getting the phone call, because it means that as being a board member or being an advisor to the company, you've put yourself into a position that you've developed relevancy with the company that you're working with, you've developed knowledge, and you've developed the ability to be a key advisor. If you don't have those, whether it's formal or informal, or those key advisors that have that level of intimacy to your business, you're in a position where you're not getting what you need to get out of those advisors. And that really, to me, kind of segues to the next point, in that if you look at all three of these bullet points, formal boards, informal boards, key advisors, what you're really trying to do is you're trying to establish a set of accountability structures. The one thing that I find with clients, and I find in my own business, that if you don't have those points where you have to be accountable to someone else, I mean, I'm a partner in my firm. Dan deals with lots of people that own 100% of the company that he's working with. And those types of people, because they get busy at times, they don't tend to have those accountability structures around them. And if you look at the board, you look at informal boards, and you look at those advisors, you need to use them as being accountability structures. Outside people that you're accountable to, that when you're going to a meeting with them, you know you have to put up. You know you have to be able to go there and present what you've done since the last time you met with them, because you don't want to be embarrassed.
No, absolutely.
So I think the other thing that, you know, Dan touched on this a little bit, is the fiduciary duties of board members. And I think one of the things that is important to understand is that a board is not a club. A board is a set of people that when you put them on the board, they have a set of duties. And that set of duties is much more expansive than what you'd ordinarily think it to be. For instance, I mean, if you look at the books and records of a company, you look at their financial controls, oftentimes the owner doesn't want somebody to tell them that they can't spend some amount of money on something. But even as a board member, you have to hold them accountable to certain things like that because you have a fiduciary duty sitting on their board.
You absolutely. That's the whole point of the board, to provide some level of expertise in a manner that's consistent with what we refer to on the board, our duties of care and loyalty, and good business judgment, if you will. That's what we're supposed to bring to the business that enhances, if you will, good decision-making outcomes. We're advisors. We don't run the company. And those lines are sometimes a bit blurred, but they're not blurred conceptually.
One question coming in. So having seen companies, small companies and private companies break apart into camps, is it possible that a CEO can select board people that are actually too close to him? Close friends, close advisors, that personal relationship becomes a hindrance?
The answer to that is yeah, absolutely. Absolutely, you can select somebody to be on your board that's going to parrot you, that is going to mimic your behaviors, is going to agree with everything that you say, is not going to be challenging. And I think with many of us, the best friends that we've ever had in life are the friends that will call you to the carpet. They will call you to the carpet because they see their role with you as being much more expansive than rubber stamping an outcome. And I think you look for some of those same characteristics out of your advisors, out of your formal board members and your informal board members. You look at those people that are invested enough that they will disagree with you, and they will disagree with you in a challenging way that is about a better outcome. And those are the people that really will help you with succession.
Yeah, it's a very interesting topic. I think everyone needs to understand, in the publicly held arena, you have to qualify. You have to be approved by the SEC. In the audit committee, for example, somebody's got to be designated as a financial expert according to a set of criteria. It's much more formal. In the privately held arena, we can't fire the CEO as the board. They own the company, all right? So they have complete freedom regarding who they ask for advice. If they want a board, who would they like to populate the board? Well, of course, it's hard to imagine that you would put an enemy on your board. All right. In the meantime, it's hard to imagine that you would put somebody on the board who has no ability to help you. And those lines are a bit fuzzy. But owners, we assume, want to do things that are good for the company. Who goes on the board becomes an interesting question, because if a friend of mine asks me would I be interested in a board of a company that he or she is running, of course I'm interested. But I'm thinking, I don't want to go, what's more important to me, your friendship or giving you good advice? It's not the easiest thing.
So the Abraham Lincoln team of rivals model could be good here.
It could be good, but if I own the company, I don't want a team of rivals, all right?
I think that's kind of the common reaction. The common reaction of people is why would I want to invite them into my living room? And it takes a bold personality to invite those people that are really going to challenge you hard into your living room. But those challenging people are the people that are going to put you into a position that promotes your succession. They promote the growth of your company, and they promote the outcomes that you want, which is kind of the segue into the next slide that we have, and that is, planning for financial outcomes that can promote succession. And, one of the things, and obviously this is coming from one guy who's got CPA at the end of his name and another guy who's got CPA at the end of his name, and, we tend to like to talk about financial statements, and if you guys really want us to, we'll dive into some debits and credits for you, but I don't think anybody really wants that. But what this slide is about is, to me, what's showing up on your financial statements is a huge part of succession. And I think a lot of times people that are running companies and people that are working on operations in companies, they look at their financial statements and they say, oh yeah, the financial statements are, we have to get those out to the bank. We have to report to some outside organization, and we have to prepare a tax return. And they look at their financial statements, and they look at the disclosures on their financial statements almost as being a product unto themselves. But the answer in the end is, your financial statements speak to you, and they speak to you about your readiness for succession. And the things that tend to promote succession is liquidity in businesses. When you look at businesses that lack liquidity, they lack the ability to be able to make hard decisions because they might not have cash balances that they really should have based on what's happening with their business. They have excessive inventories. They have receivables that don't turn the right way. And so therefore they haven't promoted liquidity on their balance sheet. When they start to talk about succession and they start to plan for succession, having dry powder on your balance sheet, and I refer to working capital as being dry powder, having dry powder on your balance sheet gives you a lot of flexibility in order to promote succession. And I think that oftentimes people look at their balance sheet as kind of being, I don't know if the right word is penance, but they don't look at it as being something that's actually speaking to them from a succession perspective. And I think in your role, Dan, one of the things that you look at as being an advisor is to say, is this a balance sheet that you can go to battle with?
Yeah, and I go right through these bullet points, Mark. Even in sources for liquidity, especially upon death and retirement, but we have key man insurance, for example. In one of the situations where a CEO passed away, we had a significant life insurance policy. This allowed us to engage in a transition with the individual's estate, if you will, regarding their shares. That on the bottom there, if somebody's going to retire, what happens to their equity position? Where does it go? Are they still interested? You don't just sort of sudden get a phone call or an email or whatever the current communication system is that XYZ died, what do we do now? You think about these things, you plan for them, because it's inevitable that succession is going to occur while on your watch, or you're going to be the one being succeeded. So one way or another, you're going to deal with it.
Wait, we're not living forever.
No,
I think that's what everybody thinks.
Yeah. The Grim Reaper is undefeated, as we say.
You're right. But there's a million stories that talk about situations where you have both planned and unplanned succession. And I can tell you from my experience, whether it's planned or it's unplanned, financial resources and liquid financial resources on your balance sheet are a situation that you can go to battle with. And the liquidity on a balance sheet really puts you into a position where you have much more flexibility to promote buyout of shareholders. You can put yourself into a position that you can sustain periods of time where you may have down earnings, or you may have other challenges in the business as you go through succession models. Liquidity is I guess I would say, the dry powder that you really want to be able to promote and have on your balance sheet. So your balance sheet and your cash flows and your income statement, they're always telling you messages, and they're telling you messages about whether you're really ready for succession. There's one point on here that I want to drill onto, and it's the third one that talks about sustainable debt structures. So many situations that I've seen in my career and that I've seen in my client base are where businesses have debt. And, you know, there's a lot of businesses out there that have debt. There's few that don't have debt, but the sustainability of the debt structures post-succession, the succession coming because you had the founder of a business who left, or you had the founder of a business who died. People think, and oftentimes erroneously think, that when the owner dies, the bank's going to still be willing to lend. They're still going to be willing to keep that $10 million mortgage in place that was guaranteed by the owner, and they think that the business is still in great shape and so forth. Lo and behold, the owner dies, and you get a nice letter from the bank, and the bank says, you know, Mr. So-and-so has died, and that's an event of default under your debt agreements, and oh, by the way, we'd like to be paid off, and you have a default rate on your debt that is 5 points higher than what it historically has been. I bet you've seen a couple of those.
Oh, yeah. This is absolutely critical for us, both from the lending perspective and the business that borrows perspective. And, you know, when I see liquidity up here, all right, I think it's easy to confuse this with having piles of money around. That's not what we're talking about. We're talking about insurance proceeds, once again. We're talking about liquid assets. So when I think about succession planning and a healthy balance sheet, I'm not an insurance person, but it's not the worst thing for me to see cash surrender value life insurance in there, which of course kicks in, obviously, when the ultimate event occurs. But these debt structures, let me tell you all something. I get involved with banks, as Mark does. They're not here to help you out when you lose your CEO. They're there to protect the interest of their shareholders, which means when critical events occur that make the debt callable, they're going to call it.
Right, and I think we've all seen it. So we're going to segue from there into a slide that we put together called financing a transaction. And this may speak a little bit to some of the one question that we had on transitions from owners to employees. And the first bullet point on this slide may be a little bit confusing, where I came up with this terminology, bank of founder / owner. And the reality behind that bullet point is many transitions, many succession plans involve seller financing. Seller financing is what I refer to as bank of founder, because oftentimes when you segue to the second bullet point here, who has investable capital? So we talked a little bit about the idea of you have the sale from the owner of the business to the current employees in the business. And you look at those employees, and the employees will tell you, I'd really like to buy a piece of the business. I've been working here for the past 10 or 15 years. I'd really like to buy a piece of this business. I love this business. How do I get into it? And the owner looks at them and says, well, bring your checkbook.
Yeah.
Bring your checkbook, and we can talk about how I get paid for my ownership in the business. And oftentimes, you have this look on the employee's face that basically says, well, I don't really have a checkbook. And it's a very common situation in today's world as you look at the transition of businesses from owners such as they are right now, who oftentimes have tons of sweat equity into their business, have bootstrapped the living daylights out of it in order to put themselves into a position where they've promoted a lot of value, and then all of a sudden turn around and try to sell it to their employees, and the employees say, I don't have anything to invest in the business. Which turns me back to, it's the bank of the founder, and it's seller financing. And so I think one of the things that you see, and I'm sure Dan's seen this before, is you have many employees who have time in their seat, but no checkbook.
Yeah.
And I think that many business succession plans are going to be backstopped by that seller financing. They're going to be backstopped because the employer or whoever the founder is going to be in a position where they're going to have to finance a big chunk of the transaction.
And they take on the risk, obviously, that it doesn't work.
Right,
and they're not in control all of a sudden.
So in our world, you sit back and you say, well, how do you mitigate that risk?
Yeah.
How do you mitigate risk? And if you talked about some of the things, if you went back to some of the things that we talked about from a management succession perspective, your risk is that the employee is not successful in running the business as you've transitioned ownership to them. So what do you do to mitigate that risk? You get them ready to run the company, which is why you say you want to get them knowledgeable about the business. You want to get them into a position where they have developed skill sets about critical decision making.
Yeah, I think this ties into part of our earlier discussions as well, Mark. A well thought out plan, there isn't this bright yellow line. You didn't own any of it yesterday, and tomorrow you own all of it, and you got to figure out how am I going to fund this overnight transition, if you will. That allowing employees over time to buy into the business, where the owner is gradually reducing their percentage of ownership in exchange for liquidity in the privately held business. And that can help, if you will, and that is a more orderly transition, but the founder has to agree to it. Once again, if they're very skittish about sharing, if you will, the equity pie, it can be a difficult thing to convince them that it's a lot better to do it now while things are running smoothly and you're in control, and we're vesting these managers and making them think like owners, as opposed to let's wait till the critical event occurs, and all of a sudden we're in a room closing the door trying to figure it out, where nobody has any money.
Right, and that's oftentimes why you see what I referred to here as stage succession.
Yeah.
And that is, you know, as Dan said, there is not a bright line. There is not a bright line between what's there now and what the next generation is. And oftentimes what you will see is this element of you're going to get in for a first bite in ownership of the business. The conversation between the founder and the owner and the employees is, I'm going to let you in. I'm going to let you into the business. I'm going to give you an opportunity to participate. And the first piece of it will have a fairly good discount on it.
Yeah.
But the last piece, when you're going to buy me out and I'm going to sail off into the sunset, is going to be a very expensive piece for you.
And it's going to make your original piece worth more, believe it or not.
That's exactly right. And I think that's a hard thing to come to grips with, because many owners look at it and say, well, just go to the bank and get some financing.
Oh, yeah, no, they're sitting there. They'll take your house, your car, everything you have is collateral. And, you know, that's a risky thing for people with families, and people are dependent upon them to tie their future economic success into one item, if you will.
Right.
So it can be done orderly. And there are ways, all right, creative ways, like, okay, let's say your job calls for a salary of $125,000, then maybe you get a piece and you work for $100,000. Something that ultimately rewards the owner for the risk they took to bring this business to the point it's at.
That's exactly right. And it's really, you know, what we often see is that in that last piece, or what I referred to as the last piece that carries the premium, it's at that point in time that you have some ability to talk to the banks about financing, because the banks want to see that next generation has some vested ownership, they have a vested tie to the business, and they want to see that they have some equity and skin in the game that they've paid for.
And it reduces the need for the bank at some level, right? If we've already gone through some transition and cashed out the principals, there's less need for the financing.
Right. And
hopefully.
So it's only as your plan migrates down the road from a succession perspective that oftentimes you really get to talk to the bank about financing, or you get to talk about venture or alternative financing. And what that speaks to is it says, well, if you thought somebody was going to buy you out in 5 years from this business, you may be really thinking about periods that are 10 years and more for you to be able to be bought out of the business.
That's a hard leap for founders when they're young, things are going well. But modern theories of optimal behavior suggest that the players in the game have a big stake in it.
And banks want to see that.
Yeah.
And venture financing wants to see that. They want to see equity. And in the succession plan, if the business owners and founders haven't set up the next generation to be able to have some of that equity in the business where they can talk about alternative financing sources, the founders actually have not done their job.
Yeah.
They've not put the next generation into a position that they can actually execute on a buy of the company.
No, they paint themselves into a financial corner.
Right.
And you know, the options then become very limited.
Right. So we're going to finish up with one last slide that I called the hard topics.
Yeah.
And some of the things that you have to reconcile with is the owner's view of valuation versus the buyer's view of valuation. Right out of the blocks, we talked about valuation, and I think this is truly a case of beauty is in the eye of the beholder.
Yeah.
You know, different valuation comes because people see risk in a business differently. And if you look at valuation theory that Dan has taught for decades and probably could teach me a few more things that I actually know right now, it's all about risk.
Well, it's all about risk and eye of the beholder, all right? I know my house is worth more than you think it's worth, all right? And there's a lot of buy low, sell high statements out there, but they're hard to come by.
Right. And one of the things that I challenge business owners on all the time is to get an outside view of valuation.
Absolutely.
And absent that, you can fall in love with your own story, you can breathe in your own ether, and you can convince yourself that your view of valuation is really right, when in the end, the most important view is the buyer's view of valuation, because they're the one who is going to actually pay that valuation. The next little topic we talked about is the emotional connection to current management and employees. I guess you could parenthetically say love the one you're with. I think that one of the big challenges that business owners have from a hard topics perspective is seeing the people around you, seeing what they've done for you in the past, and sometimes having to make a hard decision that they're not next, and they're not a part of the future. And just because they're there, you develop this emotional connection to them.
Yeah, you know, everybody can't be next. Everybody can't be part of the next step. But there are other ways to satisfy your emotional attachment to key people who have helped you get to where you are. And so you have to think about it that way. That's why the privately held board that I referred to earlier, where the owner said, look, I can't deal with selling this place. I can't deal with these people who've gotten me here losing their jobs. And the advisor said, then step out of it. Get out of the way. We'll do it for you, because otherwise you're going to die with this business. Your estate's going to get nothing. It just can't, you can't have everything here. So if you want to take care of people who've been important to you, we're going to get this business sold. You're going to get a bunch of money, and then you can do what you want with it.
And that is that emotional connection that disconnected you from what's important, and that was to produce valuation.
Absolutely. It turned out to be highly emotional. Every time this owner would get an inquiry, he'd give the inquirer my name. And I'm like, why don't you take care of it? I can't. All right, well, we respect that, and we're going forward.
Right. So that really segues into, you know, how do you implement change in leadership from the founder? I've heard it more times, more fingers than I have fingers and toes. I've heard it that I'm the CEO, I need to be here. I'm the founder. I'm the guy. Yeah. I'm the guy who has built this. I'm the woman who has determined this direction. I am next. And the challenge that we gave to people up front is really, you might not be next, and you may well be in a position that you need to spend some time to hand your baby off to the next generation, and do it in a way that is thoughtful and not like a mic drop, so to speak. The other big hard topic I think that many small and medium-sized business owners have challenges with is family as the next leaders. I have seen situations where family as the next leaders has been the best decision on the face of the earth, and I've also seen situations where family as the next leaders could not have been a worse decision. And there are some very, very difficult topics that people have to think about when they think about having a conversation where they go to their child who may be 30-plus years old and say, I really don't think you can run this business going forward. I don't think you have the skill set. And to help me help you, I'm actually going to have somebody else run the business.
Yeah.
The last couple points I think are real big realities. Coming to grips with the leader's mortality and relevancy. Mortality obviously is a gigantic issue from a succession perspective. It doesn't need much more explanation. If the leader's not around anymore and they're not there to promote succession, the thing that always scares me the most from both my own business perspective as well as people that I work with that are clients and friends is your relevancy. Can you maintain a skill set? Can you maintain thought processes? Can you maintain forward-looking thoughts that allow you to continue to be relevant in the world and have thoughts that are important to running the business? And the last topic I think is always the big topic, is do you have enough runway? And I guess it's an aviation analogy, and basically you have enough runway that the plane's not going to run off the end of the runway and crash into the woods.
And the answer to that is we never quite know precisely how much runway we have. We can look at actuarial tables, but we're pretty individual, so some people go on and on and on effectively, and other times there's random factors that we don't control that force us to make decisions like who's next.
And that is probably one of the hardest questions that you'll have to answer in the hard topics category.
And I like to assume not a lot.
And I think that's a good assumption.
Not a lot of runway. Why don't we plan as if the truck could hit somebody tomorrow? We don't have to implement it by any means, and it should be an executive session or privately discussed with owners and their advisors. So that it doesn't cause all of a sudden this discussion in closed doors and dark corners like this company's going under or we're being sold or whatever impairs the ability of all those employees to operate at their highest level.
Right. I think we're at the end, and I really hope that everybody that listened in or will be listening in got a couple nuggets to take away today. With Dan, you've got a world of experience, and
with Mark, you've got a world of experience and applied examples. We're lucky to have you come in and talk to the alums. So thank you.
Yes.
Thanks for having me.
Yes, thank you both very much. You are both wonderful people to have speaking on this topic. It was a master class if people don't realize.